A three-digit number controls more of your life than almost anything else. It decides whether you get that apartment, whether you drive that car off the lot, whether the bank says yes or no to your mortgage application. And the scariest part? Most people have no idea how that number actually works, or where it even came from. Today we're going deep. We're talking about the full history of credit scores, how they're calculated, why the system is broken in ways nobody talks about, and exactly what you can do to take control of yours. This is the video I wish I had when I was starting out. Welcome back to Hidden Wealth Files. No fluff, no filler, just real information that helps you move smarter with your money. If you're new here, subscribe and hit the bell so you never miss a weekly upload. Let's get into it. Let's start at the very beginning. What actually is a credit score? A credit score is a three-digit number, typically ranging from 300 to 850, that tells lenders how creditworthy you are. Think of it as a financial reputation score. The higher the number, the more trustworthy you appear to banks, landlords, and lenders. The lower the number, the more risk they think you pose. Now here's why this matters so much. That number affects whether you qualify for a credit card, whether you can rent an apartment, whether a bank will approve your car loan, what interest rate you'll pay on a mortgage. In some cases, even whether an employer will hire you. Yes, employers. Some industries run credit checks during the hiring process. Your three-digit score can literally determine whether you get a job. So now that we understand what it is and why it matters, let's talk about where it came from. Because the history of credit scoring is a lot darker and more complicated than most people realize. Believe it or not, formal credit reporting in the United States goes all the way back to 1841. That's nearly 200 years ago. It started not with individual consumers, but with businesses. Merchants needed a way to evaluate whether other businesses were trustworthy enough to extend credit to. Could this business partner actually pay their invoices? Were they reliable? That was the core question. To answer it, one of the first formal credit reporting agencies was established, called the Mercantile Agency. And the way they gathered information? They hired what were called agents or correspondents, basically field reporters, whose entire job was to travel around the country collecting financial intelligence on businesses and business people. Now here's where it gets disturbing. These correspondents weren't just collecting neutral financial data. They were gathering things like a person's marital status, their ethnic background, their age, their moral character, and their race. All of this information was entered into a centralized ledger kept in New York, and the evaluations these correspondents submitted were deeply, openly subjective. Your creditworthiness could be impacted by whether a correspondent personally liked you, by your skin color, by your gender, by whether they thought you were a good person, based on their own biases and worldview. This wasn't a flaw in the system. It was the system. And this matters because, as we'll get into later, many of the inequalities baked into that original model never fully went away. Fast forward to the late 19th century, and something big starts to change. Businesses, especially mass retailers, start recognizing that there's a need for individual consumer credit ratings, not just commercial ones. Here's the context. Retailers were starting to sell bigger ticket items, furniture, appliances, large household goods, and they couldn't just ask buyers to pay up front. Installment plans became common. You buy the sofa today, you pay over 12 months. But that only works if the retailer can actually trust that you'll pay. And so consumer-focused credit reporting was born out of pure business necessity. Retailers needed to know, is this customer good for it? At first, this process was entirely manual and extremely labor-intensive. Local credit bureaus would keep physical records on consumers, paper files, handwritten cards, ledgers. If you wanted a credit check, someone had to physically go through those records. And the subjectivity problem didn't go away either. Individual agents still made character judgments. Race, gender, and social standing still influenced how creditworthy someone was deemed to be. This system limped along for decades, patchy, inconsistent, and deeply biased, until technology finally stepped in to clean it up. Sort of. By the 1960s, the credit bureau landscape in the United States was completely chaotic. There were over 2,000 credit bureaus operating independently across the country. Each one kept its own records. There was no standardization, no consistency, and everything was stored on physical papers and cards, disorganized, hard to access, and near impossible to share. Then computers arrived, and the entire industry started to transform. As computing technology became more widely adopted, credit bureaus began digitizing their records. Suddenly, information that used to live in a filing cabinet in one city could be stored, processed, and accessed electronically. The number of credit bureaus shrank dramatically, as larger players consolidated the market and absorbed smaller ones. By the 1980s, the industry had largely consolidated into the three major bureaus we still know today: Equifax, Experian, and TransUnion. But digitization alone didn't solve the problem. You now had organized data, but you still needed a consistent, reliable way to interpret that data. Every lender was still essentially making their own judgment calls. There was no universal language for creditworthiness. That's where FICO comes in. The Fair Isaac Corporation, better known as FICO, was a data analytics company that had been working on credit-related analytics since the late 1950s. But their biggest moment came in 1989. FICO partnered with the national credit bureaus to develop a single, standardized credit scoring model, one formula that could be applied consistently to evaluate any consumer's creditworthiness. No more individual agents making character judgments. No more subjective assessments. Just math. That model became what we now call the FICO score, and it was genuinely revolutionary for its time. For the first time, a consumer anywhere in the country could have their creditworthiness evaluated using the same framework. A lender in Texas and a lender in New York were now speaking the same financial language. The score ranged from 300 to 850, and for the most part, the higher the number, the better. Today, the majority of lenders in the United States still use FICO scores as their primary decision-making tool. It has become the industry standard, and for better or worse, it shapes the financial lives of hundreds of millions of people. So how does FICO actually calculate your score today? According to FICO, your score is based on 5 key factors. Let's break each one down. 1. Payment history, 35%. This is the single biggest factor. It answers one simple question: have you paid your bills on time? Every on-time payment builds your score. Every missed or late payment hurts it. This is why payment history carries more weight than everything else combined. It's the most direct indicator of whether you'll pay back what you borrow. 2. Amounts owed, 30%. This is also called your credit utilization rate. It measures how much of your available credit you're actually using. If your credit limit across all your cards is $10,000 and you're carrying a $7,000 balance, your utilization is 70%, and that's a red flag to lenders. A general rule of thumb: keep utilization below 30%, and ideally below 10% if you want to optimize your score. 3. Length of credit history, 15%. How long have you had credit? This factor looks at the age of your oldest account, your newest account, and the average age of all accounts. Longer history generally means a better score, which is why financial advisors often say, don't close old credit cards, even if you don't use them much. 4. New credit, 10%. Every time you apply for new credit, a new card, a loan, a line of credit, the lender performs a hard inquiry on your report. Too many hard inquiries in a short period signals to lenders that you might be in financial distress or taking on too much at once. This factor tracks how often you're opening new accounts. 5. Credit mix, 10%. This looks at the variety of credit products you have: credit cards, installment loans, auto loans, mortgages, student loans. Having a healthy mix shows lenders that you can manage different types of credit responsibly. Those 5 factors. That's the formula. Simple in concept, but the weight of each factor means that the strategies for improving your score aren't always obvious. Here's where I want to be real with you, because this is the part of the credit score conversation most finance channels skip. The FICO score is not a perfect system. Far from it. Start with this number. 26 million Americans are considered credit invisible. That means they have no credit file at all, no score, no history, no record. And it should come as no surprise that the majority of those 26 million people are Black, Hispanic, and from low-income households. Why? Because the system rewards people who already have access to credit. To build a good credit score, you need credit accounts. But to get credit accounts, you need a good credit score. It's a circular trap, and people who weren't given access to begin with get locked out entirely. And the echoes of that 1841 system are still being felt. The bias didn't evaporate when the computers came in. It got baked into the data. Decades of discriminatory lending practices, redlining, and denied opportunities meant that by the time FICO created its standardized model, certain communities were already starting from behind. Beyond that, the system doesn't account for a lot of things that actually demonstrate financial responsibility. In many countries, rent payments are a person's biggest monthly expense, and for years, paying rent on time did absolutely nothing for your credit score in the United States. The same with utility bills, phone payments, and other consistent financial obligations. And speaking of other countries, Let's talk about that for a second. Step outside North America, and you'll find that many countries don't use a credit scoring system at all. Countries across Africa, parts of Asia, and much of the developing world fund consumer lending programs through entirely different mechanisms: community trust, income verification, asset-based lending, and relationship banking. And it works. That tells us something important. The credit score isn't the only way to evaluate financial trustworthiness. It's just the one that became dominant in the American system. Okay, so we've covered the history, the formula, and the flaws. Now what? Here's my honest recommendation. You can't opt out of the system, so you need to learn how to work it in your favor. Here's how. Pay on time, every time. Set up auto-pay, if you have to. This single habit protects the 35% of your score that matters most. Keep your utilization low. If you have credit cards, try to keep balances well below 30% of your limit. If you're carrying high balances, making extra payments throughout the month, not just at the statement date, can help. Don't close old accounts. Length of history matters. An old card you barely use is still working for you in the background. Be strategic about applications. Don't apply for multiple credit products in a short window. Space out applications, and only apply when you actually need to. Check your report regularly. You're entitled to a free credit report from each of the 3 bureaus annually. Errors on credit reports are more common than people think, and a mistake you didn't cause can drag your score down. Dispute anything that looks wrong. Build history if you're starting from zero. If your credit invisible, a secured credit card or a credit builder loan can help you start establishing a track record. Here's the bottom line. The credit score system started with bias built into its foundation. It's evolved significantly, but it still has real gaps, and it still disproportionately affects people who are already disadvantaged. Understanding that history doesn't just make you more informed, it helps you see the system for what it is, rather than letting it define you. You're not a number, but in a world where that number carries weight, you might as well know exactly how to control it. Take ownership of your score. Check it, understand it, improve it, and teach the people around you how to do the same. If this video helped you, drop a like. It genuinely helps this channel grow. And comment below. What's your biggest credit score question or challenge right now? I read every single comment, and I want to know where you're at. Subscribe if you haven't already, and I'll see you next week.